gold is generating, returns for a mutual fund investor should be higher than the earnings growth that is projected.
Hi Pratik, good morning. Good to see you. I wanted to ask you about two of those poster boys the last few years, Bajaj Finance and HDFC Bank. Both of them were big wealth creators. However, in the last 12 to around 18 months, they have been big underperformers. What's your view on them? Do you think it's time to get into these names? Because very good franchises, they've made a lot of wealth for investors. But the last couple of years have been very, there's been a stark underperformance from them. Your view particularly on both these two names?
So typically, I avoid single stock comments. I'll speak more philosophically. In financials, particularly, if there is a amalgamation and a new platform happens which is way larger than the earlier one, and if there is a regime change, I think markets take time to see what is happening, to digest, and in that period the stocks may move sideways, languish, whatever you may want to say. Second, in financials, lot of the premiums that some of the names may have commanded was on account of the face that was seen, which reposed confidence of the street. And, versus others, people may have parked monies into those names. So it's not only these two names, it's also others. Now, when those faces change, whether the new faces will inspire same degree of following and confidence, only can tell, is the thought. Until then, the franchises may not be able to retain the premium valuations.
Okay, now there is a little pressure that's seeping into the broader markets. The mid-cap index, although the headline index is doing okay, but look at what's happening in the broader market. Something like a Suven Pharma is down 9%. A lot of these names, NBCC is down about 5% odd, BEML is down about 3%, Macrotech Developers is down 3%. You get a sense that there's some money being taken off in some of these, gaining sectors. So Hoodco is down about 2%, Metro Brands, BEML, by the way, case in point, down 3%. So just keep an eye out on that. Bank Nifty is also dragging its feet at the moment. Pratik, I wanted your thoughts on the auto sector, because over there you're seeing a very good performance for across the board, right? I mean, whether it's something like a Bajaj Auto, which is doing really well, commentary has picked up, Tata Motors management is very confident about the Jaguar Land Rover business. How are you feeling about that pack in general, and are the valuations looking exciting to you?
No, so this is a space which is the leader in terms of earnings growth for the quarter, and has been the leader in earnings growth over last few quarters actually, and I think stock prices have followed. The challenge here is for a long-term investor that whether the market is giving valuations to both ICE and EV part of the business. At some point in time, you will not have both; you will have one of the two. So that becomes a challenge. But otherwise, for the near term, I think this is a space where the earnings growth momentum should be expected to sustain. And if we believe markets follow earnings growth, I think the performance could also sustain. So those are the thoughts there.
Oops, okay, I think, all right. We will actually leave it at that. Thanks, Pratik, for joining in and giving us your views. Well, that's the word coming in on the market, which, by the way, is very quiet right now. So gives us some time to pour over individual stocks. By the way, Suven Pharma is the one that's the accident of the morning, so far at least, down almost about 9% odd. And want you to take notice on that stock as well. But let's do one thing. Let's talk about Alembic Pharma now. The stock has been surging in trade on the back of a steady Q3 performance. The margins have recovered sequentially, and there's an improvement in the India business. R.K. Baheti, who is the CFO of Alembic Pharma, joins us now to talk about that. Mr. Baheti, thanks a lot for joining in. If you can tell us, first about the operational performance, which has been very strong. Your margins have moved up to about 16.5%, which is a 4-quarter high. Can you tell us what led to this kind of improvement? Has pricing pressure eased? And what is the sustainable margin band that Alembic Pharma can eke out in FY25?
Yeah, thanks, Sonia. Thanks for putting Alembic Pharma on your prestigious channel. Very valid question, very good question actually. So last couple of years, we were suffering from steep price erosion in US market, in US generic market. On top of that, our facilities were pending approval because of disruption in travel schedule of US FDA. So year 23, I mean calendar year 23 has been good for us in the sense that we got all our facilities inspected, passed. We have got EIR for all the facilities. So some of the new investments which we have made in injectable plant and in our onco plant has started now commercial production. Though initially at a little lower scale, but at least they have started commercial production. Products have been approved. We have started launches in US market. So that has been very positive for us. Of course, the margin improvement is a factor of, okay, let me put it this way. India branded business is more stable business. The margins are predictable. Growth also is more or less predictable. I mean, as long as you don't goof up. And we have done some good work at the field. So domestic business has, actually it is outperforming the market in most of the categories. And the margins are good there. But the improvement at company level margins is largely driven by US generics, where prices have stabilized. Our new launches has given us some traction, and this improvement. Also, we did a cost reduction. You would have noticed that R&D, which was almost 13% of our revenue at one point of time, is now about 7-8%. So that has also given us some space for margin expansion.
So just to conclude this point on margins, right? You're saying that costs have gone down and there's an improvement in the US generics business. Has it all been factored into your margins at 16%, or is there scope to raise it further? And if yes, what would the band be?
It is actually there is a scope for raising it further. And why I'm saying this without predicting future, because markets are so unpredictable. US markets are so very unpredictable. So without predicting future, why I'm saying this is further improvable is our new facilities. All my expenses are being charged to P&L, whereas they still are at a fraction of their capacity utilization. So once they have better capacity utilization, more products in the market, more revenues, the margin improvement will come automatically because overheads are all covered. And anything beyond this should directly add to the margins.
All right. Hi, good morning, Mr. Baheti.
This of course goes with an assumption that the US stays this way or improves further. I mean, it doesn't go down.
Got it. All right. Hi, good morning, Mr. Baheti. Nigel on this side. So taking that kind of an assumption that US doesn't see further pressure and the international business, ex of US, it sees growth. Domestic business is looking healthy and your reduction in R&D cost. A couple of brokerages are estimating that you'll be at around 20% margins by FY26. Do you think that's possible? Point number one. And point number two, the US business has been delivering a quarterly run rate of around that $50-55 million per quarter. What is the range we should be working with for the coming quarters?
So as a policy, we don't give guidance because giving guidance, particularly when 60% of your business is US driven, is very risky, I would say. But this margin improvements, as has been talked by people, is achievable. R&D cost will continue because see, R&D cost, we are not sacrificing future growth. We are still investing in injectable. We are still investing in onco products as far as R&D is concerned. Where we have reduced is derma because we have covered our space. Almost all of our products are now ready for technology transfer and then commercial production. And we have also reduced our R&D investments on oral solids because the margins there have really gone down. Other investments are continuing. So, but R&D would be still 7-8%. And with R&D 7-8%, I think a 20% margin in a couple of years is doable.
Got it. And what about the US business, the run rate that you were going to give us?
That is, that's the almost impossible to predict. But I think what I can say is that like in last couple of years, we have launched 20 new products and we'll continue to launch about 5-6 products every quarter. that is 20 products. Now, if these products get a traction and the prices remain stable, then I think we should be doing a good US business.
All right. Mr. Bayati, hi, good morning. The R&D, won't you have to, once all of this happens, right? I mean, there's operating leverage which kicks off as capacity utilization increases. That's the base sort of assumption why you're sounding optimistic. But isn't R&D a critical aspect? I mean, wouldn't you have to raise it back up? As you said, it's come down from 13 to 7% now. But won't it go up again? Won't you have to?
Yeah, no, it's a valid point. But the next level of R&D investments would happen only when we go for a branded product or a discovery product, and which will need massive R&D. So for that, company would have a different strategy, either of partnership or sharing of cost or some such thing. For the existing generic business, and that's what I clarified, for the existing generic business, I think this R&D level, 500 crore annually, should be good for us.
Okay, what about the API business? That has been on the weaker side. In fact, I think year on year, the API business is down double digits. Has that been the case with the entire industry? Do you see things improving? And what is the way forward? What's the run rate? Because I think it slipped below this 300 crores of sales after 4 or 5 quarters.
No, very right. So, I mean, assessing any business on a quarterly basis is not probably correct. These are business, these are supplies to other formulators. So it also depends on how they build up their inventory and how they stack up their production cycles. But I think API business, we are most optimistic about, and we have been saying this for last few years. Last few years, our CAGR in API has been almost 15%. Base is quite good, and we'll continue to have a 7 to 10% growth. Even in the current year, if you look at the YTD number, we are 7-8% up from the previous numbers. So I'm not too worried, and we remain optimistic on API business. Yes, there has been some pricing pressure on API business also. See, when the generic business is under pressure, some pressure on prices also spill over to API, which is natural. So with the generic stabilizing, hopefully API business will also improve.
So, Bayati, for FY25 on top line, overall top line, I have a broker's estimate. I mean, they are looking at about, they're modeling at about a 12% growth in top line. Now, would that, are we in the, is the analyst in the ballpark?
I would refrain from saying that, but okay, they are not way off the mark.
Okay, around 12%, but without not being specific. Got that.
Yeah. Okay, all right. And how is your balance sheet looking? I think you have a small debt of around 600 crores odd. Any plans to repay that?
So we have been paying, actually, the cash flow, the last year, 2023, cash flow has been the most positive, what you call indication of our business. We generated net cash flow after meeting capex and after meeting all the working capital requirement of about 300 crore in 9 months period. And we have paid dividend, and then we have reduced borrowing. I think by March itself, March 24 itself, we'll have another reduction of 150 crores in borrowing. So next year we will be virtually debt free.
Okay, all right. Well, thanks a lot for joining in, and all the best in your journey to become debt free. All the best with the business as well. That's Alembic Pharma doing pretty well, actually, up almost about 4% now at the 1,000 rupee mark. But can't say the same about Suven Pharma, which is now down almost 10% after reporting its earnings. So Suven Pharma, as we were telling you earlier as well, big volume and price action on the downside. Let's do one thing. Let's take a quick break. On the other side, we'll connect with Sivaramakrishnan Ganapati, the Vice Chairman and Managing Director of Gokul Exports, to discuss their Q3 numbers. We'll also connect with Anuj Jain, the MD and CEO of Kansai Nerolac, to discuss their Q3 performance and how rural demand is shaping up. Stay tuned.
Well, the next company on our radar is Gokul Exports. They posted a good recovery in Q3. Revenue as well did see some bit of a growth. Margins expanded sequentially. And the company also went ahead and announced another acquisition, Matrix Clothing, for around 490 crore rupees. Mr. Ganapathy, the VC and MD of the company, joins us on the show. Hi, Mr. Ganapathy. First of all, congratulations on a pretty good showing. I was looking at your numbers and you have grown while the industry has degrown. So even in a difficult time, you're doing pretty well. Good on that.
Thank you.
You know, before we get to talk about the way ahead for the company on the whole, I want to ask you about Matrix Clothing. You've got it at a good valuation of around 7 times EV upon EBITDA. How much can you scale up this business, with the current investments that they've already put in? I think it's done around 590 crores approximately in terms of sales. So what is the scale up options you have? And margins were a little bit lower than what you're already doing at around 11%. Do you think it gets to Gokul Das levels, say, in the coming year itself?
So I think there is at a minimum 10 to 15% scale up possibility, at Matrix. And beyond that, we will have to add capacity. They already have the ability to expand in other regions like Jharkhand, where they have one facility in Ranchi, and there is land available for future expansion. So there are further expansion possibilities as the company operates in those regions. So I don't see scalability as a problem going forward. As far as margins are concerned, I think, their margins would be similar to ours. There is a scope for improvement in margins. I think, this year itself, they're doing better in terms of margins. So that trajectory will be kept.
So just sticking on this point itself, currently the company, going by what they have, they can go up to say around 650, 660 crores. And beyond that, you'll have to put in some additional investments.
That's right.
Right. So what are the investments you're planning on putting out there, and what could be the asset turn? If you put 50, 100 crores, what could be the asset turn on that?
So the asset turn will remain at around 4 times. For 4 times the investment. That's kind of norm for our industry. We will try to do better than that if possible. But they're in a similar industry, so it's all similar metrics.
Mr. Ganapathy, hi, good morning. Prashant here, and congratulations on what looks like another great deal.
Thank you.
So, a string of acquisitions, how are you thinking about, because the last one was also a large one, right? And you were in the process of sort of bringing all of that together. I think happened starting January. Now there's one more. Will there be more? Are you seeing more opportunities really? What's the strategy? What's the thought process?
So see, we are quite intensely focused on organic growth. So that focus will continue. Organically improve the business, organically grow, and inorganic growth are all opportunistic. We are open-minded about it. We have a certain scale, size, and systems and process stability that we believe that we will be able to acquire companies and expand. We are very choosy about which company we will work with, inorganically. And that's why when we look at opportunities, we look at it for multiple reasons. One, is it adding some new customers? Two, is it giving me new geography? In the Matrix's case, we had an opportunity to, get more revenue from Europe, which Matrix focuses on. Is it giving me a new product category, which in this case is knits? So if it gives multiple, add-on benefits to us, then we are fairly open-minded about acquisition, and we will continue to be open-minded about it. We will also be mindful of our ability to integrate all these acquisitions, so we won't do too many things simultaneously as well. But nevertheless, if a great opportunity comes our way, we will be open-minded about it.
No, I get that. So just a follow on. One is, do you have like a standing instruction with bankers to get you more deals? I mean, of course, I'm assuming you reject most and then pick what you really like. So that's one. I mean, my question is, will we see more in terms of inorganic, even though, as you say, you are choosy? And second, on that benefits, you highlighted many. So you have these bunch of companies that you're integrating. Are there significant cross-sell opportunities here? I mean, in the customer universe?
Sure. There are cross-sell opportunities. It doesn't materialize immediately, but in a year or so, it will materialize because, there is the whole notion of getting factories approved, etc. There is a long lead time or a cycle associated with it. But nevertheless, there is a significant amount of cross-sell opportunities that are available. As far as acquisitions go, we don't have any standing instructions for bankers, but we do get into a lot of deal flows. We get to see them. We don't pursue most of them. And, if something interests us, we will look at it.
Okay. Well, we hope to hear from you on that front for sure. But, you were talking about the fact that you have a large exposure in Europe, right, for Matrix. I think about 45% of your business comes from there. Can you tell me what is, or in general, I mean, the Europe as a geography is big for you. Can you tell me what is the situation on the ground in terms of exports? Are you seeing any kind of recovery there, or is there still a problem pocket? And what kind of growth are you hoping to see?
Sure. Just to clarify, for Gokuldas per se, US is the biggest bucket. We are almost 75 to 80% exposed to US from an export standpoint. And Matrix is more Europe-centric, far more Europe-centric than we are. So that's where the synergy comes. As far as the market conditions go, we've seen a fair amount of lull in calendar 2023. Even though the retail sales in the US went up by 4%, the buyers were buying a lot less. In fact, US brands bought almost 23% less in 2023. European brands bought almost 14 to 16% less compared to 2022, 23 over 22. So the reason for that was they were all sitting on excess inventory. Most of the excess inventory has been worked out by many of the brands. And now they are looking at buying, getting back to normal business levels. So we are seeing reasonable amount of traction growing back for us. And over the quarters ahead, we will see that play out.
Okay, all right. So, I'm just looking at the numbers. For this year, I think you're going to end more or less flattish, as you all had guided earlier. Margins are showing some kind of improvement. My question to you is, in FY26, going by how things are shaping up with both these two acquisitions coming in, will the revenues of Gokuldas exports double and margins head towards mid-teens, say around 14 to 15%? Going by what we have on the table as of now, things can change. If there is something that breaks out in the global markets, then you can't really forecast that. But as of current reckoning, do you think doubling of revenues on the base of FY24 with margins at mid-teens is doable?
So again, FY24, we may show some growth over FY23,
Okay.
simply because Atraco will also start contributing to FY24 levels. So if I take FY23 levels and then take FY26, we may not double, but we may be nearly there. We are kind of directionally going in that in that area. So
Okay.
so we feel that fairly strong growth in 26 over 23 will be there.
And margins?
And margins. I feel that we will since there are multiple organizations and we will be integrating all of them. I think if there is a 1% improvement in margin from where we are, I'll be very happy. Substantial improvement we will all attempt, but we will have to see how the market conditions are as well.
All right. Shiva, could you tell us what is the QIP for?
Again, sure.
Yeah.
So we have taken a permission from the board, and we are going to the shareholders for an approval for QIP. Clearly, for any future growth requirements, we will explore all options. And that's with that in mind, we went ahead with the approval for a QIP. We'll take a call as we go along as to how do we use it or what do we do with the QIP.
Okay, all right. Shiva, we'll leave it there. Thank you very much for your time. Great speaking with you. Appreciate you joining in. And congratulations once again. Hope to speak with you soon again. There's much more. I mean, what's happening with the US business and, in that sense, you've been a great guide to that market, inventory and destocking, etc. But we'll have you back soon again. Gokuldas, it's moved up even as we were speaking with the management, 1.5% higher nearly on the stock. Kansai Nerolac is the next one. Third quarter performance from the company came in line with industry growth expectations. It registered a sharp expansion in gross margins and they registered double-digit volume growth as well. We have Tanuj Jain, Managing Director and CEO at Kansai Nerolac, joining in to take some questions. Tanuj, great to have you with us here. Good morning. Appreciate your time on CNBC TV18. Could you first start by telling us what was the volume growth in both the decorative and the automotive business? It's early for the fourth quarter, but we're 1 month done. Has the momentum sustained in Q4 so far?
Good morning. Thanks for having me here. So for decorative, generally we track volume value both. So volume growth has been double digit in Q3. And generally in the industrial segment or auto segment, we don't track volume. It is based on the value. So the value has been double digit. For the coming quarter, as you're saying, I think the industrial momentum, specifically the auto momentum, if you see the passenger vehicles, the four-wheelers, the production growth of the industry has been in the line of 5 to 6% at the YTD level. And what we have seen in the last 3 months is the green shoot in the two-wheeler business, where the production growth of the industry was going negative if we see the first quarter or second quarter. But in the third quarter, it bounced back. And we feel that this momentum will continue. So we feel that the industrial momentum will continue, and in decorative, the growth will be led by volume.
Okay, the growth will be led by volume. Okay. I didn't understand the split between decorative and the automotive business. What has the volume growth been so far? And if you're saying growth will be led by volume going ahead, do you expect to see double-digit growth in both these segments, auto and decorative? What's the outlook?
It is what it looks like. As I said that, in the rural segment, which was not doing so well in Q1 and Q2, we have seen Q3, there's a better recovery in the rural. And if that continues, I think in the decorative, maybe 8 to 10% of volume growth is possible to continue. And industrial, the momentum, the automotive, the momentum is good. So the value growth should be closer to the double digit.
All right. Hi, sir. Morning. In the decorative business, but there's going to be a couple of large players that are going to come in there. So what's your strategy? I think your current market share is around 9 to 10%. You can update us in your decorative business. What is the market share? And also, would you focus more on industrial because of the competition coming in?
Yeah, so, the advantage with us is that since we are one of the most diversified portfolio, and we are present in automotive, the non-auto industrial segment, and we are focused on all, these segments. So that's the industrial segment definitely comes handy for us. Within the decorative, you rightly said, our market share is in single digit. And we have been working in terms of our paint plus our differentiated products, the influencer strategy, the service what we introduce. And we are quite focused on the steps what we have taken, because last 1 year, 1.5 year, quarter-on-quarter basis, we have seen the improvement as the inputs, what we are putting in decorative, and we are seeing the results. So we'll remain focused on that. Competition has always been there in this industry, and healthy competition is always good for the consumer, for the industry, as it keeps you always on the toes. So I think the healthy competition is always welcome in the industry.
Got that. Now, just to go on to some other matters, you sold 2 land parcels worth about 1,400 crores. Could you tell us what is the plan with the cash? And are you going to dispose of any other sort of non-core assets that you may have?
No, these were like 2 non-core assets, and the one we sold earlier, and the second one is now subject to the condition precedents. So we have signed the AFS, and we are definitely looking ahead in terms of using this for the business opportunities.
In what way, sir?
It's too early to comment upon it, but ultimately we are going to be focused on the business growth.
Would it come back? Would a part of it come back as a special dividend or something, or this will all be used in the operations?
I cannot comment at this moment of time. As I said, the first priority would be the business opportunity, but if it does not work out, then there may be a possibility of, as you are saying.
Okay. All right. What are we looking at? If you can just come back to the overall picture, right? You said 8 to 10% volume growth in FY25 is possible. Got that. That is across the board. But can you just help us in terms of what are you looking at as a sustainable revenue growth, say over the next couple of years? What could be the range? And also on the margin front, what are you targeting? Because in Q3, your revenue growth was barely 5%.
See, if you see the past last 5 years, 10 years, I think the paint industry, especially in the decorative, has been growing in the double digit. Maybe last 1.5 years, it is slightly lower. And I don't see any reason that why this kind of growth should not continue, because the penetration of paint is still in the range of 50 to 55%. And as the urbanization is happening, more marketing efforts, I think this will continue to grow. Also, still the 25-30% of the industry is informal. So the formalization also is happening. So I think next couple of years, the double-digit volume growth is definitely achievable for the decorative segment. Industrial generally is cyclical, but there are two parts of industrial. One is the auto, the other is the non-auto industrial, which we call high-performance coating. And looking at the way the government is spending, they're increasing their budget on capex, the capex cycle. I think we feel that the capital good industry, and we are one of the major suppliers to the capital good industry. So even the non-auto industrial segment, the outlook looks very positive.
All right, Mr. Jain, to get to the point that Sonia asked you on margins as well, your gross margins are expanding, but your EBITDA margins for the last 3 quarters have come down, in fact. Could you tell us what is the sustainable EBITDA margin from here on? And also, tying in with that itself, how much are you spending on advertising costs as a percentage of sales? Are you looking at upping that?
So in our case, since that our business mix is quite different, it's industrial and decorative. So if you look at the category level, the gross margins, remain intact. But every quarter, there is a change in the business mix, and that's why you see the difference. In gross margin and EBITDA level, the difference, one, as you said, that in the advertising, where we have already upped our expenditure by more than 1%, and that's why you see a difference in gross margin and EBITDA level. So overall, what we are spending in advertising is about 4.5% to 5%.
And sustainable margins, sir? I didn't get that. As the graph is showing us on the screen, it's come down in Q1 from 15.5% to around 12.7%. Outlook from here on?
That's what I'm saying, that we don't look at the quarter level. You can look at the YTD annual level. And gross margins are the clear picture that depending on the business mix, the EBITDA level, it's changed. But if you look at the YTD level, which is around 14%, that's like a sustainable margins.
All right, we'll let you go on that note. Thank you so much for joining us and giving us, an update on the business. That's Kansai Nerolac. Let's do one thing. Let's take it straight to Shilpa Raut, Senior Analyst Derivative at Prabhudas Lilladher, to tell us about the market picture. Shilpa, hi, welcome to the show. The market is not bad, actually. The Nifty is holding up with gains of around 75 odd points. The mid-caps are doing far better, up about 1%. Your take on what we've seen so far, and what is the expectation for the rest of the day?
The rest of the day, I believe, Nifty will consolidate it in this range of 21,700 to 21,950. This broad range is something that we will see markets, moving this sideways. For Bank Nifty, I believe, again, 45,500 is holding very well. So as long as we are above this, we can expect targets till 46,200.
Okay, all right. Shilpa, that's about the indices, but I wanted to ask you about Paytm. There's a lot of fundamental news that's moving around, and fundamental analysis suggesting that, in fact, the stock could take support at, various levels. How is it looking at the charts? As we speak, it's one of the biggest volume buzzers, and it's at the high point of the day.
It's, quite said and done about Paytm, and every analyst, having some sort of opinion about this. But as per a chart, if you see that this 400 levels, it's yesterday also we were talking about the same. As long as it is holding that, I believe, there's some sort of relief rally that is playing out. So anybody, who has taken a short positions and in a couple of days here, then they should be exiting the gains now. So, where there's so much of, the confusion about a particular script, I believe, avoiding is the best place.
Got it. Then tell us, what are your picks as of now?
I have 2 buys. The first one would be in JK Cement. I have recommended the same in Prabhudas Lilladher right now at around the same levels, 4,400 right now. It futures trading at around 4,400. I believe, the stock has a very strong chance of moving around 4,500 to 4,550 in no time, with a stop loss of 4,370 from here. So that is the first buy. The second buy, I would continue with the Ipca Lab, my morning buy. The futures is trading at around 1170. So, if anybody has already taken the position, keep your trading stop loss at 1150 and look for targets till 1200 to 1230.
Okay, thanks a lot for that. For now, I think the market is just awaiting a listing, right? BLS e-Services. That list today, so all eyes will be on that in a bit. By the way, PSUs, we were telling you about that, how PSUs could be under a bit of pressure. So it's not just PSU banks, but across the board, PSUs are seeing some profit taking. Hudco is down in the red, BEML is down, some banks are under pressure as well. So is this the start of a sell-off in the PSU space? Maybe too soon to tell, but at least, this is something that you should be looking at. So we're just awaiting the new listing, BLS e-services. Remember, it was subscribed over 160 times. Look at that, 131%. So, okay. Then that is true. I mean, you should you should continue clapping for them. Look at that, debut on the last read, phenomenal, 127% higher. It actually received an overwhelming response in the IPO itself. So, from all categories of investors. So it was expected, I guess, to list at this big bang level. 127% higher now on BLS e-services. It's going to use all these proceeds to strengthen its technological infrastructure, develop new capabilities. The company has spoken about consolidating its existing platforms, etc. It's a technology-enabled digital service provider. So it provides services to major banks in India, assisted e-services, e-governance programs at the grassroots level, etc. So listed at 309, the issue price was 135. I guess this one was expected.
It's a very, very strong one. I just want to point out what's happening with Fortis. I mean, I'm not sure if this, is it numbers, but 7.5% higher on Fortis, and stocks at about 467. Large volumes as well. I've not seen this one participate in such a way lately. Max Health is, of course, a company we spoke with the hospital side recently. Their numbers were good. Stock was kind of sideways, and it moved up yesterday after the earnings. So that's the hospital space. We'll take a quick commercial break here. We'll come back and we'll sort of put the focus on some stocks which are on the move. Stay with us. Right back.
All right, Britannia will be reporting its Q3 earnings today, so all eyes are going to be on that. Mangalam joins us with what to expect from the stock. Mangalam, over to you.
Well, a slightly soft quarter expected from Britannia because demand environment is muted, and that's what we've seen in all the other FMCG companies as well. What are you looking at? 2.5% revenue growth. That's just about 4,300 crores on the top line. The EBITDA is largely flat. You're looking at a number of around 815 crores. The margins would again be a 50 basis points dip as compared to the same time last year. So 19% is what the street is largely expecting. The net profit now optically will be a big decline of 41%. The absolute number is 550 crores. So this time around, it's the absolute number which will be more important because remember the same time last quarter, there was an exceptional gain of around 375 crores itself. The domestic volume growth, again, middling between 2 to 3% because for the revenues to grow 2.5%, the company would have taken some price cuts, passed on the price benefits to the consumers to spur up demand. And over the last few quarters, if you notice, the Britannia volume growth has been very feeble, just around 0.1% odd itself. And that's what's expected. It's a challenging demand environment. Continued rural distribution is something that the company is, on. And importantly, we'll also watch out for how the performance of their new launches and non-biscuit adjacencies like dairy, cakes, etc. are doing too. But management commentary extremely important for Britannia, given the sort of feeble numbers that we've been seeing on the top line for the last few quarters.
All right, Mangalam, thanks very much for that. Ekta is here. Zydus Life is going to consider a buyback. Ekta?
Well, yes, Zydus Life is in focus. There will be a board meet on the 9th of Feb where they will be considering a buyback. Remember that this is not the first buyback that they will be considering. They have been, doing buybacks in the last couple of years. And the latest was in May 2022. They had undertaken a buyback worth around 750 odd crores, which was at 650 rupees per share and equal to around 1.13% of the fully paid up capital. So Feb 9th is when we'll get more details with regards to Zydus's buyback.
All right, thanks a lot for that. Well, ASK Automotive is the other stock that we are talking about. Well, you may not have memory of this because it's a recent listing. It listed on 14 November last year. And it is the largest manufacturer of two-wheeler brake systems. So the brakes that they make for bikes, ASK Automotive manufactures these brakes. So they manufacture the entire panel assemblies, brake shoes, brake linings, etc. They do it for motorcycles, scooters, passenger vehicles and commercial vehicles. And they have a market share of 50% in the OEM space. Now, very good set of numbers in Q3 is what this company reported. Revenue growth of almost 20%, EBITDA growth of almost 40%. Margins up 150 basis point, and it's a relatively high margin business. I mean, almost 11% margins is what the company is sitting on, and the profits for this company are up 71%. So it's a very strong growth, and the company in their press release says that this advanced braking systems business, in which they are the market leader, that is stable and has delivered sustained performance both in the domestic as well as in the export market. And hence the street likes that. The stock is up almost about 3%. But IEX is the other one that we're looking at this morning. Vivek is here to give us the lowdown. Vivek, over to you.
Well, that's right. So IEX, this is on the back of an operational update that the company has provided for the month of January 2024. So good volumes are coming in as far as IEX is concerned in January. Total volumes is up 26% on a year-on-year basis. Now, the volumes were largely aided by a gain as far as market share is concerned and also strong renewable energy certificate volumes. So that basically indicates that from the lows of 79% that the company faced as far as market share is concerned in October 2023, this time around the market share is well in northwards of 90%. So that's a strong gain and regaining of market share as far as IEX is concerned. Market clearing price was down 6%. The company had already alluded to this on the back of improved sell-side liquidity. Day-ahead market volumes again up 13.2%, coming in at 4,540 million units. So good operational update from IEX is what is causing the cheer.
All right, Vivek, thank you very much for that. So that is what you have on IEX. The market's up about 85 points right now. And of course, the stock at the moment is Paytm, which is bouncing off the day's low. But 100 rupees, I mean, even if you're playing it for a trade, it's a decent bounce that you've got already. We'll take a quick commercial break here. On the other side, our special segment, it's the economy. My colleague Lata will get chatting with Abhishek Upadhyay of ICICI Securities PD and Santanu Sengupta of Goldman Sachs, and they discuss what to expect from the upcoming RBI policy later this week. Stay tuned.
Welcome to It's the Economy. The Monetary Policy Committee's meeting starts today with the decision due on Thursday. How much has changed in the last few weeks? Quite a bit. One, inflation has been lower than forecast for both November and December. Two, the budget has announced a lower than expected deficit for this year and the next year. And three, the Reserve Bank, after keeping liquidity tight, has provided 2.5 lakh crore of cash to banks through that 15-day repo on January 5th. And hence, the call rate, the interbank call rate, the rate at which banks borrow from one another for 1 day, has fallen to 6.5% after 5 months. Now, given this changed background, what can the Reserve Bank announce on Thursday? I have with me Shantanu Sengupta, the Chief Economist at Goldman Sachs India, and Abhishek Upadhyay, the Senior Economist, ICICI Securities PD. Gentlemen, good morning and thank you very much for joining me. Shantanu, that's the first question to you. The ambience has changed compared to December 8th. 2 inflation readings below, interim budget deficit below expectation, and looks like the Reserve Bank has changed its mind on liquidity. So, what are you expecting? Can you expect a stance change?
Hi, Lata. No, we are not expecting a stance change in this meeting. We think the MPC will hold on to the policy rates, reiterate their commitment to the 4% inflation target, as the governor has been doing in the last few RBI policy meetings. If you look at high-frequency data, it's showing an improvement in investment activity. Survey data, both services and manufacturing PMI has been solid, well above 50. Services PMI above 60. Headline inflation, in our view, is likely to be around 5.3% in the first quarter. That is the current quarter, driven by high food inflation, even though core has declined to 4% or slightly below. So the RBI, in our view, will correctly claim that they have made significant progress in bringing down inflation. They'll call out for the steady decline in core inflation, which likely indicates that monetary policy is working. But as the governor said in the last press conference, that inflation management cannot be on autopilot with the future path clouded with uncertain food prices. So I think they'll still call out for vigilance and the target of 4%. Liquidity is slightly different. Liquidity tightness in the system was due to the government not spending. Some of the government's spending, in our view, will come back in February and March. While system liquidity is still in deficit to the tune of about 1 trillion plus, overnight you will see there's been sizable placements with the SDF facility of the RBIs, and therefore overnight rates came down. But again, you saw the RBI come out with VRRR auctions also, which is indicating that in our view, that is a signaling from the RBI that they wouldn't want the overnight to drop to repo or below. Again, between December 15th and now, RBI has conducted 10 plus variable rate repo auctions to infuse liquidity when the system was tight due to no government spending. And now they have, over the past week or so, announced 3 variable rate reverse repo operations. So I think they will try to be nimble about liquidity management going forward until they are very clear about the Fed's path turning, and then can get into easing of liquidity and change of stance mode.
No, let me just persist. Maybe I shouldn't have clubbed both liquidity and stance. But isn't there enough reason for a change in stance? Inflation numbers below expectation, fiscal deficit really delivering. You don't think that that should move them closer to a change in stance, Shantanu?
In our view, Lata, the change in stance and liquidity will almost go hand in hand. There's no point of a change in stance without changing liquidity in the system for the overnight rates to fall to repo or below. So when the RBI gets into an easing mode, that is when they can let the liquidity be in surplus, let the overnight rates drop to repo or below, probably towards the SDF, when they're getting into the easing cycle.
Okay. What's your view, Abhishek? My small point is, or rather my major point is, that between December 8 and February 8, 2 inflation readings lower, fiscal deficit much lower than expected. So is there a chance that they either change the stance or even indicate that liquidity is now perennially going to keep call at 6.5 rather than 6.75. In some way, will they indicate that things are softer and rates can ease a bit?
No, Lata, so we do think that this is a live meeting for stance change. It's a close call, but we do think that there has been significant improvement in domestic and global backdrop for RBI to now seriously consider some change in language. As you mentioned, core inflation has now dipped to below 4%, and the generalization of price pressures, which was a risk in the previous quarter, is not showing any signs of crystallizing. Also, on the global part, we know that now after the December FOMC meeting, now deep rate cuts are priced in all developed markets. Crude prices also haven't increased despite all the geopolitical concerns. So given all this, we do think that there has been substantial progress. Whether the stance change happens in this meeting or next, we are somewhat agnostic. But at the same time, I do think that RBI shifting to 14-day repos and backing that up with more fine-tuning repos to actively bring down overnight rates from MSF, which was the case over the last nearly 4 months, closer to repo now, is acknowledgement that things have progressed and we are moving in that direction of stance change. It is possible that if stance change doesn't happen in this meeting, they would create conditions by providing a balanced commentary, which would indicate that that shift could happen perhaps in the April meeting. So the key point you mentioned with overnight rates coming down, anyways, to that extent, the requirement of them to change stance is moot. We don't think change in stance would necessarily merit imminent rate cuts. That is not our view. So RBI can always balance their commentary to indicate that part. So so in that light, we do think this is a live meeting.
Okay. To get back to Shantanu, what then are you expecting? Is it a cut-paste December 8 wording and attitude, or will there be some nuance changes? If yes, what?
No, undoubtedly there will be nuance changes. I mean, as I said at the outset, there's been significant progress in bringing down inflation, and the RBI, in our view, will correctly claim that monetary policy has been working in bringing down inflation. At the same time, headline at 5% plus is not something that they will take comfort from, and they will sound out that 4% is the medium-term target. Also, remember, if you look at the trajectory of inflation that the RBI has in the last meeting, it's about 5.5% in the first 2 quarters of this calendar year. You drop towards 4% and then go back again up towards 5%. That drop towards 4% is purely on the basis of the base effects that you've seen in the current fiscal year, so the previous calendar year's Q3. And therefore, the RBI will really want to have headline sustainably below 5 at least before they want to go in for a stance change. The other thing is that on global front, there are still some uncertainties on the horizon. You look at the Red Sea disruptions on one hand. The second is that there's a continuous repricing of the Fed funds rate path globally. Now, if you look at Indian bond yields also post the very good budget, and credit to the government for adhering to the path of fiscal consolidation, the 10-year bonds gained about 9 or 10 basis points and gave up half of those gains with the US data coming in strong. So there will be a bit of this pricing and repricing of the Fed path going on for the next quarter or so until the world really settles down to where the Fed path is finally going to. And that's when other central banks possibly will be in a better position to change more conclusively towards an easing path.
Do you think, Shantanu, that that the Reserve Bank is now more likely to keep the call at 6.5?
Yeah, I would say the call now is more likely to be in the region of 6.5, 6.75, rather than being at 6.75 for the last month or so. But the call at 6.75 for the last month or so was also a function of the government's spending not coming through. and therefore your system liquidity being in an extreme deficit scenario. The RBI was proactive. They came out with the VRR auctions. But as soon as call, that's the signaling in our view. As soon as call dropped to repo or below, they were very active in terms of coming out with the VRR auctions to signal that 650 is sort of the bottom that we are looking at. So somewhere in the region of 650, 675 is where we would say they would want to call until they make up their mind about when the easing path starts later in the year.
Okay. What's your sense, Abhishek? Do you think that call is likely to remain closer to 6.5, even if the government doesn't spend starting April? Of course, they will spend through March 31. Do you think the Reserve Bank will be proactive in keeping the call rate at 6.5? And more importantly, a more general question: do you think the cost of capital falls for companies? If there is a bond index inclusion, the yield curve may slip. Overall, can companies borrow more cheaply in the next 6 months, Abhishek?
So, to the point Shantanu was mentioning, I would say that RBI always has should always have a way to control overnight rates, whether government surplus is high or low. RBI, always had the toolkit to ensure that overnight rates trade near repo. It is just that they wanted to leverage the corridor, given the uncertainties about generalization of food inflation into core and the FX risks which were coming from the global side. The very fact that RBI is now actively trying to bring down overnight rates from NSF to repo is a sign that they believe there has been progress in terms of mitigation of those risks. So, that is a key point. We're not saying that stance change, should happen towards, and the new stance should be accommodation. We are saying the stance change should be neutral, and even with neutral stance, overnight rate should be, about close to repo rate only. On the second point about cost of funds for companies, we do think that monetary policy transmission is now more or less complete, and as you head into the next fiscal year, what market will focus on is possible start of rate cut cycle at some point. Also, liquidity conditions might ease a bit, especially, and which tends to be the case generally also at the start of the fiscal year. So it's possible, government bonds, while they have been quite range recently, will continue to trade with a positive bias. We could have 10-year yields dipping below 7% also. And that could spill over into cost of funds,
borrowing costs,
corporates, etc., that you're talking about.
Okay. Shantanu, unfortunately out of time, but a very quick question. Do you think that they will at least prepare the market for a stance change?
Possible. We think that is possible. That is possible through, dialing down the language, saying again, reiterating that we have made great progress on core inflation, and if this continues, then there's a possibility of a stance change. I think that language change is something that we would be expecting. It's just that given the uncertainties globally, we think that probably the April meeting is more appropriate for a stance change, and thereafter easing into the second half of this year, this calendar year, so August onwards, rather than start easing now. But as we discussed, I think 675 towards somewhere in the region of 650, 675 is already progress in terms of somewhat of an easing path.
Fair point. So I think both of you are more or less on the same page. Even Abhishek, I guess, betting that perhaps if not February, it could be April, but the Reserve Bank will indicate perhaps a change in stance, making for a slightly easier monetary policy. Some bit of dovishness is likely in terms of the cost of money. That will be an important change, and we will touch base with all of you after the policy. Thank you very much for joining us. Wrap up on Bazaar. Chatbusters coming.